to the Can Fin Homes Q3 FY25 earnings conference call hosted by Investec Capital Services India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidesh Jain from Investec Capital. Thank you, and over to you, sir.
Thank you, Zico. Good afternoon, everyone. Welcome to the Q3 FY25 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Vikram Saha, Deputy MD, Mr. Apurav Agarwal, CFO, Mr. Prakash, General Manager, Mr. Prashant Joshi from Can Fin Homes Limited. I would now like to hand over the call to Mr. Suresh Iyer for his opening comments. Over to you, sir.
Yeah, good afternoon, everyone. Thank you, Nidesh, for the introduction. Welcome to this earnings call for Q3 of FY25. Just to give a brief highlights of the performance of the quarter. In terms of disbursements, the company had originally indicated that we would be doing somewhere in the range of about 10% higher than Q2. Unfortunately, we've had a slight setback in the state of Karnataka, particularly where because of the e-Khata issue, we had some drop in disbursements and about 400 crores of business we have had to pass on, or in fact has not materialized because the registrations have not been happening. So as a result of which, on the disbursement front, the company has only been able to have a very flat disbursements of 1879 crores as against what we had originally would have been somewhere in the range of about 2300 to 2400 crores. As a result of this lower disbursements, we've had an impact in the AUM growth also, which is now stands at 9% for the year, so far for the 3 quarters of the year. Going forward in terms of disbursements, the position in Karnataka is slightly appears to be improving with some e-Khatas getting issued. As of about 20 days back, out of 10 lakh applications for e-Khata, only about 45,000 approximately e-Khatas had been issued. But a very recent report also indicates that about 1,25,000 e-Khatas have now been issued. So slowly there seems to be some movement on the release of e-Khatas. So going forward, this will be a very key monitorable for us in terms of our disbursement growth and consequently our AUM growth. In terms of collections, the performance has been satisfactory. The gross NPA stands at 0.92%. There has been a slight increase in the NPA. However, SMA stage 2 level has been almost the same. There is a minor 15 bits increase in the SMA 0, but as indicated last quarter also, we've had approximately about 770 crore of portfolio wherein the outstandings are less than around 850, which is the check bounce charges. So the customers have paid their installments, but because of the charges of about 850 which are debited in this thing, as a result of this, the accounts stand in the SMA 0 level. Barring the 770 crores, the cases where the really SMA 0 where one installment or more than 1,000 rupees is outstanding, that is in line with what was there last quarter as well. In fact, it would be lower than the last quarter number. In terms of the provisioning, as a result of this, there is an increase in the provisioning as well. However, with this matter which we are now following up, the provisioning in Q4 where we expect the recoveries to also improve, we expect that the provisioning in the Q4 will be very marginal, if at all, and therefore the credit cost for the entire year is likely to be in the guided range of about 15 bits only. As for the AUM growth and the projections for the Q4, we expect the disbursements to be marginally in the range of what we have done in Q4 of last year. And if Karnataka improves, then it could improve a little better than that as well. And therefore, as I mentioned, the release of e-Khatas in the state of Karnataka is going to be a key monitorable in terms of disbursements and AUM growth. In terms of the liability, on the liability side, we have had some positive developments. As at the beginning of the quarter, we had about 35% of our bank borrowings which were linked to MCLR. But during the quarter, we have been able to shift all the loans either to a repo rate, or we have repaid those loans, as a result of which the entire bank borrowing book that we are having is linked to either repo rate or is linked to the T-bills. So we don't have any bank borrowings which is linked to the MCLR. So this has also helped us slightly in bringing down our cost of borrowing, because we have been, along with the shift to the repo rate, we've also been able to slightly negotiate the rate of interest on the term loans as well. The second development on the liability side has been that we have also raised 1,600 crores during the quarter from NHB, which has come at a lower rate of approximately 7.6%, which is lower than by 30-35 bits compared to the bank borrowing that we normally have. As a result of this, we on the cost of borrowing side, the cost of borrowing for the 9 months has come down by 2 bits. And on the other side, on the yield side, since we have been guiding that marginally, we have been looking at a little bit on the SENP product as well as on the LAP book. Because of that, we have also seen a slight improvement in our yield on the books, which stands at 10.14% for the 9 months ended, as against 10.12 as at the end of the last quarter. So on the borrowing side, we have been able to reduce the borrowing cost by 2 bits, whereas on the yield we have been able to improve by 2 bits, as a result of which the spread has marginally improved. So going forward, in terms of the spread and NIM, we continue to have the same guidance of 2.5% for spread and 3.5% for NIM. As a result of which, we are hopeful that the year we should be able to comfortably close with a ROE of 17 plus and ROA of 2.1 plus. On terms of the OPEX, during the quarter there has been no major change, and whatever little has been experienced because of the change in our IT systems in the first 3 quarters, the same has also continued in the 4th quarter of the calendar year. And therefore, in terms of the overall cost for the year, the cost to income ratio has marginally come down compared to the 2nd quarter. And this 4th quarter also, there is no major cost factor which is going to impact. Therefore, the cost to income ratio may not vary much. The only other aspect is that in terms of the IT, as we have been guiding that the company has embarked on a major IT transformation project. So during the 3rd quarter, we have concluded that RFP process, and we have been able to finalize on the bid, which is going to IBM. So we going forward in the next coming 3 quarters, we'll be working with IBM to implement the entire IT transformation, which includes the LOS, the LMS, DMS, HRMS, and all other modules, including certain aspects of infrastructure and security and as well. So this, of course, is likely, as per the initial schedule, to be implemented in the 3rd quarter of the next financial year, which is in the October-December 2026 quarter. So 2025, I'm sorry, October to December 2025. So a little bit of cost in the next year might slightly go up because of the capex and the opex, which will be there in the last second and the 3rd and 4th quarter of the next financial year. So this is in brief the broad highlights of the performance of the company during the 3rd quarter. I now leave it to the audience for any queries, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania with Nuvama. Please go ahead.
Hello, sir. Hi. So my first question is on general growth, nothing to do with Karnataka. So a lot of lenders tell us that, there's a volume decline. Most of the growth is being driven by value only. So does that hold true for you as well? So that's the first part of my question on growth. And the second part is that in terms of rate competition, obviously private banks have stopped competing on rates in a big way. But is there still a lot of rate competition in housing from NBFCs, PSU banks, or has it settled down? Where do we stand on rate competition and competitive intensity? That's my second question. And I have a third one also on these RBI guidelines about parent and subsidiary not doing the same kind of business. Have you had a discussion with Canara Bank? Where do you stand on that?
Yeah, thank you, Maruk. I'll answer one by one. So, in terms of the growth, as I mentioned, I probably in an interview in the morning, that other than Karnataka and Telangana, we have had a positive growth, or other we are doing quite well in the rest of the places. In fact, North and some Rajasthan, Gujarat, Tamil Nadu, all these regions are doing well for us. In terms of amount, we in fact, if you would have noticed that our average ticket size for the housing part has marginally come down from 25 lakhs to 23 lakhs. Mainly because we have had, Karnataka and Telangana, we've had higher ticket sizes. So basically, in terms of the numbers, we have still been able to get the numbers. That is why only in terms of the whatever loss we've had in terms of Karnataka and a little bit in Telangana is what is reflecting. Otherwise, we are not seeing much of an issue in terms of numbers. We continue to get the same amount of inquiries, although it was December somehow was a little soft, we felt, but then January again is looking good the first 15 days. So I mean it probably was just some other factor. I wouldn't give way to that. The second, as regards rate of interest being a factor, you are right. Actually, the rate of interest is not so much of a factor now. In fact, even in earlier days, it used to be more of, takeover plus top-up, which was the major factor. And, of course, rate of interest was always there, but it was always to another segment because it was always, the tier 1 and metro and the very high-end customers who would be really going for it. Otherwise, in the mid to lower end of the segment, rate was not anyway so much of a factor. It was more the speed of giving the loan, the ability to first of all give a loan to that particular segment, and the geographical penetration, which were the main key parameters for decision making. So rate of competition is not so much of an issue. The third point regarding RBI guideline, which was the 4th October draft circular, the parent bank has already given certain feedback to the RBI, and I guess all the other banks also have given feedback. So it is now up to the bank to first the RBI to come out with the guidelines or to take cognizance of or whatever decision or consider all those points which have been suggested and then come out with it. As of now, it appears that there is no clarity as to whether or when or how it will be implemented. So there has been no clear thing, but in the past also we have indicated that if at all the RBI comes out with a guideline, Canara Bank will definitely have to implement it, and it is always abided by the regulations. So that will whatever will be there will happen. It is looks like there could be some extension of time, or probably there could be some exceptions, or some changes in the. Maybe going forward it may be implemented or something like that. Those are the kind of suggestions which appear to have been shared by the various banks.
Thank you, sir. Thank you.
Thank you.
Thank you. The next question is from Praveen Kumar from Aquitas Capital Advisors. Please go ahead.
Yeah, thank you for the opportunity. I wanted to, I also had like 2 to 3 questions. The first one was on your NIM, the NIMs that you have been delivering, but vis-a-vis your NIM targets were, as you keep guiding, it's closer to 3.5%, right? So while we understand that, growth, there is a geographical flavor to the growth setback, but is there an opportunity to, give up some of the yields and get closer to your NIM targets, but also drive growth? That was the first question. Related question is on branch expansion. I think at the beginning of the year and during the year, you have guided to a net branch expansion of about 15 branches, whereas there doesn't seem to be any addition during the year net. Looks like you're still at 219 branches. So wanted to get some clarity on that. The third question was on your employee cost. YOY, there is a mid-teens kind of a growth in your employee cost, whereas the number of branches don't seem to have changed much. Now, part of this could be driven by, I think you have mentioned in the past that you wanted to bring down your DSA sourcing. Maybe part of it might be contributed by employees for that, but wanted to get more insights on that as well. Those are my three questions. Thank you.
Yeah. Thank you, Praveen. Your question on NIM target of 3.5 that we have been guiding, whereas we have been roughly in the range of about 3.75. But that the second thing is, we've also been guiding that we would not want to compromise on our spread, which is 2.5, and we have been hovering around 2.56. This quarter it is 2.6, but otherwise it was 2.54, 2.56. Therefore, there is not much of a scope to, compromise too much on the pricing of the products, particularly, and therefore, there is not much of a thing. However, we have tried. And you would have observed that we have also opened up our lab a little bit, which we had shared a couple of quarters back. And as a result of which, our lab portfolio, which used to be about 5%, has marginally improved to about 6% now. Similarly, the second change was that we had indicated we might also be looking at slight deviation or change from our
Sorry to interrupt, sir. So you're not audible.
Is it better now?
Yes, sir. Please go ahead.
Yeah, sorry. So I don't know whether you were able to hear the first point. The first I just said was that last we have slightly improved from 5% to 6%. And that was one thing where we have tried. Second thing is, SENP also we have opened up a little bit, and from 72% salary, now it has come down to 70%. So SENP and professional is now constituting 30%. So that also is another area where we have slightly tried to push the growth, or we have tried to expand our product range and segment range so that we can target a little wider customer base. So that is one. The second question was regarding branch expansion. So yes, we have guided for 15 branches, and we had also indicated that this 15 will be net. So basically what has happened is during the second quarter and third quarters, mainly the third quarter, we have actually also reviewed our branches. Some of the branches which are very too close to each other and are kind of cannibalizing on the customer base or things like that, or some cases where the growth is not looking very positive. We have in fact closed or merged 10 of the branches and have opened 10 other branches vis-a-vis in slightly different geographies or maybe a little further away or things like that. So basically there have been 10 additional branches which have come up which will help us in tapping the customers in a little different geographies also. So the net is not appearing to be higher, and going forward we still have about 15 branches which are in the pipeline. 11 of the branches are almost beyond the stage of execution and everything, interior work and things like that. So in Q4 they will be opening up, and 4 branches are at the execution stage with the landlords. So that also are in the pipeline. So 15 branches will be there. And last year also we had opened up the branches mainly in Q3 and Q4 only. So that is the way we have been going about. This quarter also we will be looking at 15 branches. 10 which have been opened up, I have only replaced the other branches, but 15 net additional branches will now come up in this quarter. The third is as regards employee cost. So yes, there has been an employee increase. The number of staff have also increased, and there is a sequential increase in the staff cost as well as the staff number. So two things. One, yes, we have strengthened some of the geographies where we had where the business staff have also been actually used because we have strengthened our internal assurance functions also. So some of the staff have also been utilized for that. So the number is not looking in terms of the risk. Plus we have also already in line with the new branches which are going to be opened up. Some of the staff have already been recruited and are under training at some of the nearby branches for the new branches which are also being planned. So that is the main thing. As and when the 15 branches in Q4 will get added, these staff will be moved to the new locations also. So I guess I've answered that also, Praveen. Right?
Thank you. Thanks.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Sir, what percentage of this SMA 0 of 260 crore would be accounts where just the check bounce charges are not paid? And related to it, have you also seen any increase in bounce rates in the recent past? And if you can also explain if there has been any increase, is it related to any particular product or any particular market?
Yeah, is that it? Can I?
Yeah. I mean, I have a question. I have a few follow-ups later on. Yeah.
Sure. No, actually, in terms of, as I mentioned earlier, in SMA 0, we have about 2,500 and some 90 crores, which are the portfolio, which is in SMA 0. Out of that, 770 crore portfolio related to aggregating to 770 crore are such cases where only the check bounce charges or some minimal charges are pending, and the value of these charges and everything is to the tune of less than 850, including the GST that we charge. So that is the thing. 770 crore is the portfolio in respect of which the charges only are pending, which means their customers have paid the EMI, but because of the charges and everything, they are outstanding. Obviously, the portioning will first be towards the outstanding charges. Therefore, it may appear as this, that the principal is outstanding and they are rightly classified as SMA 0. But then if it is basically that the customer had a check bounce, but he immediately paid back the original EMI, but not the charges. So those are the kind of cases. That is aggregating to 770 crores out of 2,593 crores. Second, as regards check bounce, actually for the last 4 quarters, our check bounce ratios, that is NACH bounce ratios, have remained in the same level. We've not seen, it's only a marginal decimal kind of a thing, would have gone up 0.93, would have become 0.87 or something like that, but not beyond that. So we've not done it, but I guess we will, since you mentioned it, I think it's a good point. We'll evaluate whether there is within that also any change or shift in the segment-wise analysis.
So just 2 follow-ups. One is, why the approvals are also down like disbursements by 20% Q on Q? So did we also went slow in sourcing of loans in this quarter? I mean, disbursement got stuck because of slow registrations, but why the sourcing or the approvals were also low in the quarter?
See, actually, in the month of October, when this issue of e-Khata was new, we had about 160 crore of cases which were sanctioned. Okay, and subsequent to that, the sanction also, we have a validity of 15 days. If the customer doesn't accept the sanction or doesn't further progress on that, we also temporarily hold the sanction or cancel the sanctions. So basically, we've had that kind of problem also. This is practically only 1 month equivalent of sanctions, which is there about. So 150 odd crores that is there is only less than a month old sanctions, which we are still holding as valid sanctions.
Just a last question on the consistent increase in portfolio yield, right? So even in this quarter, we had portfolio yield improving by 2 basis points at the overall portfolio level. So one you explained is because of the changing product mix and the customer profile mix moving towards SENP. But there also seems to be some, back book repricing happening. So is there a portion of the existing loans which is being repriced, upwards, or something, which is supporting the yields improving for us?
Yeah, so there are major reason, of course, as I mentioned, is because of a portfolio of SENP where we are charging, half a percentage point higher rate of interest, and that has also increased, as I mentioned, from 28 to 30%. Second is LAP book, where again we are charging half a percent higher than the link to the particular segment. So effectively, that is also increased from 5% to 6%. This is the major increase. But the second thing is, yes, as an annual practice, we have a reappraisal of our customer profiling, and if that happens and the customer's profile slightly deteriorates, it could be a slight increase in the rate of interest. Second thing is, we have some portion of the book where customers go for a P plus C, that is plot plus construction. If within 18 months the customer does not initiate the construction, then in that case we convert the loan and charge 2% higher by converting into a plot loan and reclassifying it as from a housing to a non-housing category. So that is another small percentage which would have added a little bit. And yes, in some cases there was a initial offer price for 1 year or something, and after that we have a review to we give a discount in the first year. So over the card rate. So that portfolio small, some very small book would also get repriced, but that is not the major reason.
Got it. So thank you so much, and best of luck.
Yeah, thanks.
Thank you. The next question comes from the line of Shripal Doshi with Equirus. Please go ahead.
Hi, sir. Good afternoon. Thank you for giving me the opportunity. So my question was on the disbursement side again. So you highlighted that there was an issue in Karnataka, but also in Hyderabad and so in the Telangana state. What is the problem there?
See, in Telangana, we have already said that ever since the new government came out in February 24, that is the new Congress government, they have reviewed some of the approvals given by the previous TRS government. They have also set up a department called Hydra. Okay, now this Hydra, basically what the claim is that there have been many approvals given by the previous government on land which was either government-owned land or on water bodies. So some of the cases, the government also went ahead and started doing demolition of such properties wherein customers originally had a valid approved plan given by the previous municipal corporation of the previous during the previous government regime. So this actually has affected the sentiment. A lot of project launches or things have happened. We have also had customers who have cancelled their loans and said that we are not going ahead with the transactions and things like that because the sentiment overall is getting affected. This has also affected the particularly the real estate, and this thing has affected the cash flow also in the state, particularly in Hyderabad and all. Of course, recent a month or 2 months back or something, the government did say that they would now not at least demolish the properties, but they would forward such cases to a new department for environment and things like that. But at least the sentiment has still not improved, and we're having problems with new cases coming in over there. So we've had a negative growth in Telangana. In fact, Telangana is almost 33% down in terms of disbursement, and it has been there for the entire year now, starting from the Q1 itself, because this thing started somewhere in the early part of the financial year.
Got it. And this is to contribute like what percent of our disbursement?
See, actually, Karnataka contributes about 34% and Telangana about 15%. So approximately between the two of them, it's about 50% of the business used to be from these two states.
Got it, sir. Got it. And so just a bit on the growth side, and to the previous participant's question also on approval. So have we tightened our underwriting given the issues in the other retail products for the customer? So in terms of maybe earlier there were deviations on FOIR or on LTV. So have we tried to look at that aspect apart from the Karnataka and Tamil Nadu issue or Telangana issue that we are highlighting? But or are we seeing this at a sector level or at our company level?
No. The Karnataka and Telangana issues are at the entire sector level only, because I am sure other lenders also would be facing this problem, and I am very sure they are facing this problem. At least whoever I have indicated, I've interacted with in the HFC forum or in other colleagues in the industry, they also share the same view about both the states of Karnataka and Telangana. Other than that, in terms of credit norms, we have not tightened any new norms or any tightening we have not done. It's just the same as I indicated. In fact, on the contrary, we have opened up our LAP product, which was earlier being done only for existing customers. It was not there for new customers. Therefore, if you would see that earlier we used to report our average ticket size for LAP as around 8 lakhs, but this quarter you would see that it has increased to 13 lakhs. That is because we have also started targeting new customers. also started targeting new customers for in the LAP product as well. So basically, we have not tightened any norms. We have in fact only opened up our LAP, and we have also increased our focus on SENP. So it's not there is no adverse or tightening of the norms.
Got it. And so just one last part was on the SMA 0 front. So if you look at even without this impact of you highlighted the charges for the bounce rate for the bouncing of the EMI. So apart from that, if you look at the trend has been increasing only in the last 4 quarters. So do you see that this trend will go down or move downwards in the 4Q?
Well, of course, it should go down. But let me also say that SMA 0 we will definitely come down, because this one issue also last quarter, and we had indicated that this new RBI thing about not keeping an advance EMI is also hurting us. And otherwise, we used to keep and account it at the end of the month, and advances is one EMI we used to carry as an advance. So that was also helping us as a buffer for us, which is now not there. But SMA 0 definitely we will arrest and get it done. In terms of NPA, in fact, I can definitely say that in Q4 we will see some better numbers, and it will come down to 0.8 or anything. But actually, if you look at the trend 2021 onwards, in fact, it has been hovering between 0.91 and 0.8 or something. So roughly that is the range in which our NPAs have been going, barring the 2 years when the COVID restructuring was there and all the SMA2 accounts and SMA, many of the customers were eligible for COVID restructuring, and therefore those accounts were classified as regular. But barring those 2 years, if you look at it from that point onwards, it has always been hovering around in the range of between 0.8 to 0.91 only in terms of NPA. So that is what it is. I don't expect that it would go down and deteriorate any further. We will put pressure. Sometimes the pressure works and it comes down, particularly in Q4 and all, it does come down. But the real picture is that it is hovering around 0.9%. I think that would be a more realistic way to look at it. We will definitely bring it down in Q4, and the year-end numbers would be closer to 0.8% in terms of NPA. But again, Q1 the same customers would be facing a problem, because it is a proven fact now.
Got it. So thank you. I have more questions. I'll come in the queue. So thank you.
Thank you.
Thank you. The next question is from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. So I have 2 questions. So the first being, admittedly, while e-Khata registrations have not picked up that strongly, so for how many quarters do you see the Karnataka challenge spilling over? Second, so while incrementally our DSA sourcing has been coming down, which stands around 72-73% odd today, and given the fact that our focus is also tilting towards LAP and SMP, so what is the kind of internal sourcing or change in customer sourcing, if you could highlight there? And lastly, I'm sorry, I'm harping on the same question. So while SMA 0 has been sticky for past 2 to 3 quarters, and you're guiding 0.8% kind of GNPA for FY24, so is this stickiness now already behind? Thank you.
Sure. Yeah. Thanks, Shweta. See, this e-Khata issue, I would say, as I indicated earlier, has slightly opened up, because from the last 20 odd days, the previous report was 45,000. Now it is 1,25,000. So the government also in between had announced, the Karnataka government, that they are looking at deploying another 300 staff and providing the necessary infrastructure so that they can speed up the release of the e-Khatas. Issuance of e-Khatas. So definitely going forward, the state government is also keen to get this problem resolved, and obviously it is also affecting the revenue for the state, because registration and document, this stamp duty and all is a major source also for the government. So definitely this should not take very long. As I said, if it happens quickly for us, in Q4 also will look a little better. So that is the point. I don't expect it to go on for very long. It is more of an operational issue which should get resolved, as things go forward. Second, as regards internal sourcing, I would like to just highlight 2 points here. See, one is, the branches that we opened last year. We had about 14 branches which again got opened in the Q3 and Q4. Today, if I look at 1 year closure, almost at 1 year is over on an average for these branches. So they are already reached a level where they are delivering about approximately 75 lakh per month per branch, these new branches. So they are very much in line for reaching the break-even point in 1.5 to 2 years period that we normally mention. So that is one area which is helping us. Second thing, as regards the marketing staff, we have a sales team which is a very small team now, but now almost 3 to 3.25% of the incremental business is already coming from this channel. So that is also one positive step that is happening. Right now we only have about 34 people, and they are able to deliver about industry level productivity, and they have also been able to contribute, or like in Q3 if you speak, they have about 3 to 3.25% business has come from this channel of 34 people. So that is as regards the internal sourcing. As regard SMA and this, as I mentioned, while I said that Q4 we will put pressure and the customers will pay, and we will definitely try to work out something. So the GNPA would come down to 0.8, but yes, traditionally if you see from 21 onwards, it has been hovering in that range. So even if a customer pays in Q4, I would probably say that the stress in the customer's cash flow is definitely there. So it might still again show up in the Q1 or Q2 or something. So this set of customers is roughly moving up and down. So approximately 0.9 is the actual GNPA. In a particular quarter, they could always be coming down if with a more pressure and all. As regards SMA 0 that you mentioned, yes, we have identified that this is a major issue, and it is, since it's a recent development of this 1 month EMI advance being ruled out. So we are now looking at an alternate way how we can convince the customer. We have increased the number of SMSs that we send to the customer, and all those kind of steps we are taking, whereby we should be able to bring that down. In fact, that earlier used to be somewhere in the range of about 1800, 1900 is the range in which SMA 0 used to be there. This last couple of months or quarter is where we have slightly seen that increase because of this charges, which also we will educate the customer, we will increase our follow-ups and bring it down.
Thank you so much, sir. All the best.
Thank you. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Abhijit Tibrewal with Motilal Oswal. Please go ahead.
Yeah, thank you, and good afternoon, everyone. So just one question. If I look at the provisioning cover for our stage 3 loans or NPA loans, last 4 quarters they've been coming down from almost 48.6 to 45% now. While if I look at our standard loans cover, which is our stage 1 and stage 2 loans, last 4 quarters they've been inching up from 0.45 to almost 0.56 now. So how to read this and why is it happening?
In terms of our NPA, we have also now focusing on some of the old stickier loans, in fact more than 48 months. We have kind of bucketed based on aging, and the general tendency is always to focus on the incremental NPAs and then bring them down, because this is low hanging fruit. Okay. However, when it comes to the ECL calculation, that is the LGD, PD, and LGD. Of course, PD is there. They are the default is already there. But LGD numbers will keep on will improve if we start looking at the older loans and start recovering from the older loans, which is something which we are looking at doing. And in fact, that is something which we are now very keenly monitoring. That 48 plus month loans also, bucket wise, even 24 to 36, 36 to 4. So year wise, 12 month buckets we are worked out, and we are also looking at older loans and trying to find out solutions from the older stickier loans. That's why it is in terms of the provisioning for this thing, we are able to slightly see some improvement. The second part as regards the provisioning increasing for our stage 1, stage 2, obviously it is because of the sudden increase in the flow from regular to SMA 0 or the flow from SMA 0 to SMA 1. That is what is also going to impact the calculation. So while the recovery is also happening, the flow is also equally there. That is where the numbers of ECL calculation will reflect those numbers. So if only 10 crores are recovered and only 10 crores flow, then the numbers will be, the percentage of flow will be less. Whereas if 20 crores flow, then even if we have recovered the 20 crores, but because the flow as a number is higher, in terms of a calculation, it will show a higher flow, which will result in a higher provisioning. So in fact, that is also the number. And obviously in Q4, as soon as the SMA 0 flow reduces, the maximum hit we have had is because of the SMA 0 flow. And mainly because of the charges. The moment we are able to address that and bring it down, this will definitely come down.
Got it, sir. And just one follow-up to that, and then the next question. So, sir, going forward, what is that provision cover that I have on mind on stage 3, a more stable, a normalized kind of a number? And the other thing is, earlier in the call, you suggested that things are improving in Karnataka and the resolution should not take very long, given that it's more of an operational issue. Get better during the course of this quarter. And let's say by March, April, when we get there, if things have been addressed, then next year, what is the run rate that we have in mind in terms of disbursements?
Yeah, sure. See, in terms of our PCR for our NPA stage 3, it has roughly been about 46 to 49% is where we have roughly been doing. As I said, it depends a little bit on how much stickier loans we are able to recover from and things like that. So that would be the case. But so while on the ECL front, we will be providing whatever it is. Given an opportunity, if there is a good, slightly good year or something, or a good quarter, we will definitely like to increase by way of a management overlay. Because in the ECL, we will have to provide whatever comes out as per the calculation, which is a very scientifically devised calculation of 5-year performance of the accounts and everything. So in terms of this, if it is possible and if it's a good year, we will definitely like to increase our marginally, keep some for rainy day in terms of the management overlay. So that is the, thinking that is there. In terms of e-Khata, yes, I said it's the operational issue, and yes, we would like to, and the government also is working. So it's only fingers crossed how soon it can be sorted out so that it will get converted into business. But going forward, next year at least we don't expect that this will go on for too long. So as I said, with our North, with our Rajasthan, Gujarat, our Tamil Nadu and everybody doing well, next year definitely we continue to have the same target of 12,000 crore disbursement. So that should be around 15% AUM growth that we will be looking for in FY26.
Got it. So this is useful. Thank you, and wish you and your team the very best.
Thank you.
Thank you. The next question is from Pawan Kumar from Ratnatraya Capital. Please go ahead.
Suresh, thanks for the opportunity. I just wanted to again SMA 0. There has been a 2 consecutive quarters increase of 500 crores. So almost like what I'm trying to understand is if it is like an issue which is passing by in that sense, it seems to have persisted for 2 quarters. And secondly, on credit cost guidance, if I understood right, we are saying around 0.15 15 bits. That would almost mean no provisions for the last quarter. So how should we understand it? And on a sustainable basis for the next year, what should be the kind of provision run rate?
Sorry, I couldn't get your second question, please. I'm sorry.
If we are saying 15 bits guidance of credit cost for this year, that would mean almost like no provisions for the last quarter. So I was just trying to get some clarity on it. And also I wanted to understand next year, basically, what is the sustainable credit cost and also the cost to income kind of guidance.
Sure. See, in SMA 0, yes, last quarter we've had a 500 approximate crore increase in the SMA 0. Prior to that, it was, I think roughly it has been around 18, that percentage has remained the same. I'll work out for the quarter before that also. But, it is not something we are very, earlier also we've had the same kind of a range. So I don't think that is something. I'll come back to you on that. As regards the credit cost, yes, you are right. In Q4, normally it is the case where the recovery in NPA also happens, plus this SMA 0 also should be coming down, in which case we should be able to, contain our credit cost to the level of 15 bips approximately. That is correct. Going forward, since we have this similar kind of a ratio of the GNPA hovering between 0.8 and 0.9 and the other provisioning also. So I think we would continue to have the guidance of 15 bips approximately for in terms of a credit cost in the next year also. As for OPEX, yes, we will have an increase. We expect an increase in the next year because we have this implementation of this IT transformation project, which is approximately between 250 to 300 crores. So that is expected to be implemented in Q3. So during the year of FY26, there will be an increase in the OPEX and CAPEX for IT, and so approximately 18.5% is the cost to income ratio that we can target for FY26.
Okay, and just a clarification. So 15 bits, are you saying would be the credit cost for Q4 or 15 bits is the credit cost for FY25 as a whole? What is the guidance exactly?
For the full year, we are talking about 15 bits.
Okay, that would imply almost like very minimal kind of provisions for Q4. Right?
Very minimal. That is correct. Very minimal or nil to almost minimal kind of additional provisioning that will be required for in Q4.
Okay. Thanks, Suresh. Good best luck.
Yeah, thank you.
Thank you. The next question comes from Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So generally when there is this entire technology transformation, particularly on LMS, LOS, we have seen for the other players disruption in the business as well, be it in terms of disbursements. So would it be fair to assume that we would also see some similar kind of disbursements, and if you can quantify as to how long could that impact be in the next fiscal?
You are right. On the one side, there has been generally a disruption in the business whenever there's an implementation. But obviously, we don't want to project some disruption. We are in fact trying our level best to see that there is no disruption. Although I am 100% sure there will be some impact because any of the transformation. The current system that we are using is almost 12 years. The team has been using it. So any new system UI will change, the flow will change. There will be some amount of business process reengineering that will also be there. Some policies also will have to be reviewed. So keeping all that in mind, yes, 100% there will be some impact. How much of impact, I will not be able to say, but our efforts will obviously be to absolutely minimize the impact. And I think closer to the date of the implementation is when we will be able to exactly say, because that will give us a clearer picture. We are just embarking on the discussion as to the flow, the customization of the product, what is the level of policy changes and everything. So once that is there, a little more clarity will come. So I guess somewhere in the end of Q2 or somewhere in Q2 of next financial year is when we will have a better, clearer picture on this aspect actually. But that's a very correct point, Kunal. I mean, that there will be some disruption. We'll have to see how we manage it and how we can minimize it.
Sure, because that will also be skewed towards the busy season of second half. Yeah, so that was the general concern. Okay. And overall, in terms of cost, you indicated that, yeah, in terms of the cost to income, but if you can quantify in terms of how much could be the impact on OpEx in particular?
Sure. See, currently in IT, we are spending about 15 crore in a quarter. For 15 crore in a month.
Okay.
I'm sorry. 15 crore per 1 crore per month, 15 crore approximately with additional things in a year. I'm sorry. 15 crore a year, and the revised cost is coming to approximately 30 to 35 crore is what is the OpEx that will come in the year, because we have approximately 35 crore is the breakup, 60 to 75 crore is the capex, and the balance of the cost is spread over 7 years. It's a 7-year RFP spread over 7 years, so it will be around between 30 to 35 crore. So approximately 15 to 20 crore is the additional expense per year which will accrue or which will come because of the new project implementation.
And employee side also, should we see any increase out there in terms of like employees towards the technology, and there also the cost can go up, or this includes everything?
No, actually, the employee cost will not be as much, because we as part of the RFP have already stipulated that the SI will have to bring in about 50 staff, including the staff from the OEMs, and that cost has been factored into the RFP cost itself. And we also stipulated that post-implementation there has to be a hand-holding process wherein it will be maintained at that level. Thereafter, it will reduce to 30 people. So the cost in terms of that is already factored into the RFP cost. However, yes, we will have to do some kind of strengthening of the team, but that will be about what we have identified. It is not a very, very large number. We already have a team of about 18 people in our IT. We already have a team of identified a separate team of about 15 people from the business side also for project implementation. So that is already inbuilt, already there in the currently factored into our existing staff cost also. We may have to add about 10 odd people, which will not be a big burden in terms of cost. That is as regards this, yes.
Sure. And one clarification, you indicated in the opening remarks in terms of what was the impact of disbursements because of both Karnataka as well as Hyderabad?
It's approximately 432 to be exact is the total cost impact, which is because of these two states, and roughly Karnataka is about would be around 350 to 400 crores we would have lost because of this. We were approximately doing close to 300. Sorry?
This is in terms of disbursements.
In terms of disbursement during the quarter, we were doing approximately 275 to 300 crores per month in Karnataka. That has come down to somewhere in the range of 150.
Okay. But still, when we look at it, even if I add on to this in terms of 430 odd crores, then also it would have been maybe lower than that of Q2. Okay, so that's where the entire thing was maybe, so last time it was like 2,400 to 2,380. Even if I add on to this 432 odd crores, then also it would have been near and there wouldn't have been any growth. So is it like maybe in the some other geographies also there is some slowdown out there?
No, not really. In fact, as I said, there are little ups and downs, but by and large, in fact, if you look at what they have been doing compared to Q3 of last year, Q4 of last year, there's definitely an increase. And the Diwali day there is quite a bit of holidays during the day, so there is a little bit that's a kind of a normal thing which happens where there are too many holidays, a little bit is affected. But we don't see much because of the other states. But these two states alone put together has been about 432, so it would have been around 2314, 23 or something of that sort. Yeah, right.
Got it. Perfect. Yeah. Thank you. Thanks and all the best.
Thank you.
The next question is from the line of Anusha Raheja from Dalal and Brocha. Please go ahead.
Yeah, thanks and good afternoon, everyone. One question is on the AUM side. So how are you looking at the demand environment currently? Is there any slowdown in the overall demand?
Well, Anusha, not really. As I said, Karnataka is obviously we are not able to estimate. It's definitely gone down. Other states, it's been quite fairly okay. Although in terms of affordable, smaller ticket size, we have obviously not seeing much of a demand. Our ticket sizes have been roughly marginally improving or marginally been there only. We've not seen much of a. You would see in our presentation also that our 20 to 30 and 30 plus ticket sizes is where the disbursement growth has also increased, whereas in the 0 to 10 and 10 to 20 lakh segment it has actually come down. So there we are seeing some lower this thing, but otherwise it is okay. In the mostly the majority of the segment where we are operating, we don't see much of a problem.
Okay. And given the fact that nearly 1/3